Welcome to the InvestSense market commentary for the fourth week of November 2025. And it was a week of two halves. The end of last week, quite a lot of volatility again. And surprisingly, despite a very strong Nvidia result, the stock was up for a little while, but then it fell the next day. And this was about valuation concerns ostensibly, although over the weekend, what's come to the fore is also the fact that Google's Gemini model is catching up with OpenAI, and they're doing it with chips that could threaten Nvidia's dominance. It's not exactly the same chips, it's not going to replace them everywhere, but it does show that there's progress towards other firms, and Amazon are working on the same ones. Obviously in China there's a lot of work going on how to do more with less chips as well, as we mentioned last week. So there was a few question marks about the sustainability of the profit margins and sales of Nvidia, but that really sort of talks to the overall themes in the market, that sort of concerns around valuation. Although over the weekend, with maybe some geopolitical concerns sort of abating, that plan in Ukraine looking a little bit more realistic, for instance, and things have improved somewhat, meaning that markets are actually by and large up for the past week, and the Russell 2000, which seems to be the lightning rod for risk at the moment, along with Bitcoin, up 5%. Now that means for the month, most markets will be down a couple of percent, so it doesn't look too bad. Japan a little bit more. Australia probably one of the laggards, down about almost 4%. And CBA about a third of that actually, but the banks driving it, more than a half of the falls due to the banks, but most other sectors also down a little bit, so showing a little bit of risk off sentiment. And although you can see there down the bottom 10-year yields diverging somewhat and really not very volatile, coming down in the US, there's also fears of a sort of weakening US economy, more data coming out to suggest that's the case. But in Australia we had that strong employment data a few weeks ago, and the inflation data that came out today was also above expectations, especially on housing and food, and anyone that lives in Australia that will resonate. But as you can see, we've got a chart here showing the change in rates between today, or expected rates, and this sort of goes out from sort of a few months to a year, out to 15 years, and you can see the whole curve. This is expected interest rates going out, has hardly moved at all, just inched up a little bit, but that flat line at the beginning you can see is what people are getting used to, that the prospect of rate cuts in Australia has been taken off the table, at least by the market and by economists, and the RBA is talking that down until they see inflation a little bit more subdued, because this is evidence, even though it's the first full month of this new inflation series, and the RBA said they're going to focus more on the quarterly data and still until they get a feel for how the seasonal adjustments are working for this new data series, but it's a sign that inflation is still quite sticky. And as far as the market is concerned, you can see a very divergent picture. This is expected 1 year inflation implied by swap spreads, and you can see that in Australia it's ticked up a little bit. As I said, rates didn't move that much because the market was expecting it to some extent by all accounts, but in the US it's coming down quite rapidly, and that is this sort of divergent signal that you're seeing weakness potentially coming out of the US, or cyclical weakness, and in Australia these confusing signals, but sort of signs of economic strength and at least inflation as we saw today. Now that implies these sort of divergent paths. Now there is some evidence that the rest of the world, given the impact of tariffs, that you are having a very sort of divergent view, but the inflation data looks noisy. Now we had a chat with Andrew Hunt last night, that's covered in our What We're Working On video this week. Pretty interesting. We talk about a bunch of things, and one of the things that he's really focusing on at the moment, having done a recent trip in the US and talked to some quite sort of senior people out there in the corporate sector, but also in official circles, and they're kind of worried about what's going on in China, and also from the perspective of capital flows, which have been flowing for the past 10, 20, even 30 years into the US. That's been highly supportive of monetary and liquidity conditions. There's evidence that that's more going with already. It's been curtailed to a large extent because of this slowdown in China that seems to be starting to happen, but also the capital that they are exporting is going into, for instance, Europe primarily, and the UK. But where we get to in that conversation is that maybe this might be a bit of a mirage for Australia, and that of course we are that close to Australia, and we might see into next year some weakening as well. So maybe not so bad news for homeowners, but not so great for the economy potentially. But longer term, he's actually quite optimistic for Australia, especially if we tackle the productivity gap, about which he's quite impressed that we're talking about a lot. And he says if we actually have the wherewithal to do something about it, even though it is a big issue for the economy, we're actually in pretty good stead, lower starting levels of debt, etc. So not all pessimistic, but overall a note of caution there. And we discuss some of the assets that might be useful in a more inflationary scenario. And he talks through a few scenarios, but they all sort of seem to point the same way. And I think when you hear Trump talking about stimmy checks or tariff dividends being dumped into people's accounts, you can kind of tell which way the wind is blowing. So we don't disagree with that. And that's something that we're looking at in portfolios as well. Maybe getting a little bit more defensive and thinking about inflation hedges as well. So we'll be talking to clients about that in the coming months. But in the meantime, maybe tune into that video and look forward to talking next week. Thanks.